$3,716. That's the fee Rajesh paid at a Western Union counter in Edison, New Jersey. He's a 58-year-old man from India, a green card holder since 2014, and for 9 years he has worked 12-hour shifts running a Dunkin' Donuts franchise, month after month, while sending money home to support his elderly mother in Lucknow and his younger brother's family in Kanpur. Like clockwork, $20,800 on the 15th of every month. 9 years straight, never missing once until March 2026 when he missed a month. Not because he forgot, because he couldn't, because his bank account was frozen. Bank of America placed the hold. The reason listed, suspicious activity review pending federal inquiry. 48 hours later, 2 Homeland Security investigations agents were sitting in the parking lot of his Dunkin' Donuts location in Woodbridge. They carried a manila folder with 73 pages. Every Western Union receipt. Every bank statement. His last 4 tax returns. Total transfers flagged, $291,000 over 9 years. Then they compared it to his W-2 wages, $44,800 a year. They looked at the totals and asked him one question. Mr. Sharma, how does a man making $44,000 send $291,000 out of the country? He had a lawful explanation. He co-owns the franchise with his wife, who has her own earnings. He also receives rental income from a small property in Queens. It was all on his tax filings. It was all legitimate. But by then, it didn't matter. The investigation had already started. A SAR had already been filed. His name was already sitting in the FinCEN system. And under the IRS-ICE data sharing agreement signed in April 2025, the very tax return that proved his income sources was also part of what put him on their radar in the first place. Rajesh is okay today. He was cleared after 11 weeks and $9,000 in legal fees. But 11 weeks of frozen accounts meant he couldn't pay suppliers, couldn't run payroll properly, and couldn't send his mother her monthly support. His 79-year-old mother in Lucknow, diabetic, went 67 days without money from her son for the first time in nearly a decade. This is what the system looks like in 2026. Not for movie villains, not for drug traffickers, for ordinary people running franchises and sending money to family. And the scariest part is this. Rajesh didn't commit a crime. He didn't structure transfers. He didn't hide income. He filed every return on time. He still got pulled into an investigation because the environment changed and nobody warned him. Today, I'm going to explain what Rajesh didn't know. 5 rules, 5 traps, 5 protections. By the end of this video, you'll understand how the U.S. tracks cross-border transfers and what you can do to protect yourself and your family so you don't become the next Rajesh. Let's begin. We start with a number everyone hears, but almost nobody understands correctly. $10,000. Here's the rule. Under the Bank Secrecy Act of 1970, financial institutions in the United States, banks, credit unions, check-cashing businesses, Western Union, MoneyGram, and money service businesses are required to file a currency transaction report, a CTR, with the Financial Crimes Enforcement Network, known as FinCEN, within the U.S. Treasury. That CTR is required anytime a customer conducts cash transactions totaling $10,000 or more in a single business day. Deposit, withdrawal, exchange, transfer. If the same day cash total hits $10,000, a CTR is generated automatically and transmitted to FinCEN. Now here's what people get wrong. They think, fine, I'll just do $9,999 and I'm safe. That's not safe. That can be a federal crime. It's called structuring, and it appears in Title 31 of the U.S. Code, Section 5324. The statute says, no person shall, for the purpose of evading the reporting requirement, structure or assist in structuring any transaction with one or more domestic financial institutions. Penalties can include up to 5 years in federal prison and up to $250,000 in fines for individuals. For corporations, fines can reach $500,000. A real example, in 2005, Hasmukh Gandhi, a convenience store owner in Pleasant Hill, Texas, was sentenced to 2 years in federal prison for structuring, making repeated cash deposits just under $10,000. The bank noticed the pattern, reporting followed. IRS criminal investigation opened a case, and he went to prison. The point is simple. Do not try to game the thresholds by breaking transactions into smaller pieces. Monitoring systems are built to detect that pattern, and banks are trained to escalate it. If a bank suspects structuring, even if each transaction is under $10,000, it can file a suspicious activity report, a SAR, and that SAR goes straight to FinCEN. Now, this is where it becomes much harder for immigrants in particular. On November 28, 2025, FinCEN issued a new alert titled Alert on Cross-Border Funds Transfers Involving Illegal Aliens. In that alert, FinCEN told money service businesses, Western Union, MoneyGram, Raya agents, check cashers, and similar services, that they must file a suspicious activity report for any transaction of at least $2,000 if the business knows, suspects, or has reason to suspect the funds come from unlawful employment, or are otherwise illicitly obtained. Read that number again, $2,000, not $10,000. That means if you walk into a Western Union and send $20,100 to family in India, Mexico, Pakistan, the Philippines, Nigeria, anywhere, and the agent believes there's a reason to question the source, they are required to file a SAR. And what makes something suspicious? The alert lists red flags, frequent transfers in round numbers, transfer activity that doesn't seem consistent with the sender's occupation, multiple transfers to different recipients in the same region, use of multiple locations, incomplete or inconsistent identification, and other pattern indicators. Now think about how many of those flags can apply to ordinary law-abiding people who send support home monthly. You drive Uber. You work construction. You work in restaurants. You send $1,500, $2,000, $2,500 regularly. Pattern-based systems can treat that as unusual, even when it's completely legitimate. And here's the key connection. A SAR doesn't just sit in FinCEN and disappear. It is shareable. Under the USA Patriot Act and later authorities, SAR access extends to hundreds of agencies across federal, state, and local levels. That can include ICE, Homeland Security investigations, and the FBI. Now we get to the 2025 change that reshaped everything, the IRS-ICE Data Sharing Agreement. On April 7, 2025, the Internal Revenue Service entered a formal information sharing arrangement with Immigration and Customs Enforcement. Under that agreement, ICE can submit names and addresses of suspected undocumented immigrants to the IRS. The IRS cross-checks those names against taxpayer data, W-2s, 1099s, and returns, and can send back identity confirmation, address information, and employment details. In the first batch alone, ICE submitted 1.28 million names to the IRS. The IRS verified 47,289 individuals and sent information back to ICE. That means tens of thousands of people had tax-linked identity data transmitted into an enforcement pipeline. On May 13, 2025, U.S. District Judge Dabney Friedrich denied an attempt by immigrant advocacy groups to block the data sharing. The court found that the shared data did not fall under the privacy protections of Section 6103 of the Internal Revenue Code. Then in February 2026, another disturbing detail surfaced. Tax notes reported the IRS acknowledged it had mistakenly shared taxpayer information beyond the agreement's limits. Data for people who weren't even on the original request list. So, connect the dots. The government tells you to file taxes. It tells you to report income. Many people use an ITIN because they do not have a social security number. And now that same return can be used to confirm identity, locate an employer, verify an address, and pass details to ICE for enforcement. This is not hypothetical. It is active, documented, and in motion. On top of reporting and sharing, a new tax was added that directly affects people who send money abroad. The One Big Beautiful Bill Act, signed July 4, 2025, contains Section 4475, creating a 1% excise tax on remittance transfers sent from the United States to foreign countries. The law states, there is hereby imposed on any remittance transfer a tax equal to 1% of the amount of such transfer. The tax shall be paid by the sender. It took effect January 1st, 2026. So if you sent money on January 2nd, 2026 using cash at Western Union or MoneyGram, you already paid it. Here's the key exemption. The 1% tax does not apply when a transfer is funded by 1. A withdrawal from a U.S. bank account, 2. A U.S.-issued debit card, or 3. A U.S.-issued credit card. The tax applies when transfers are funded with cash, money orders, or cashier's checks. Real example, you send $500 in cash to your mother in Mexico each month. Under the new rule, $5 per transfer goes to the federal government. That's $60 per year. Over 10 years, $600 paid in excise tax on money you already earned and already paid income tax on. Now here's the bigger issue. If you don't have a U.S. bank account, because of documentation barriers, account closures, or access issues, you may be pushed into cash. If you're pushed into cash, you pay the tax. And cash-funded transfers can also face more reporting and monitoring under the $2,000 SAR environment described above. In 2026, many families are dealing with both the tax cost and the reporting environment at the same time. The scale is massive. In 2024, immigrants in the U.S. sent over $93 billion in remittances abroad. The Congressional Budget Office estimates the 1% tax could generate close to $10 billion over the next decade, billions extracted directly from immigrant households. There's another layer many people miss: geographic targeting orders. On March 11, 2025, FinCEN issued a GTO specifically aimed at money service businesses operating near the U.S.-Mexico border. Under that GTO, MSBs in designated areas must report transactions above a much lower threshold, well below the normal $10,000 CTR trigger. The exact threshold depends on the region, but the directive requires enhanced monitoring of cross-border activity. So, if you live in Texas, Arizona, New Mexico, or Southern California, and you use local remittance services, your transactions may face a lower reporting bar simply because of your zip code. The authority cited is USA Patriot Act Section 311, which allows FinCEN to designate geographic areas as money laundering concerns. In practice, it means heightened financial surveillance near the border. Now I want to explain the enforcement chain, how a normal transfer can become agents at your job. Step 1. You send money. The MSB files a CTR or SAR to FinCEN. Step 2. FinCEN systems flag patterns, multiple reports tied to one person, repeated transfers, amounts that appear inconsistent with reported work. Step 3. Under the IRS-ICE data sharing agreement, ICE submits names and IRS cross-checking happens. Step 4. If reported income doesn't align with transfer volume, say you report $22,000 but send $48,000, discrepancies can lead to referrals. Step 5. Homeland Security investigations may open a case, conduct checks, show up at a home or workplace, and subpoena records. And this chain can begin with a single $2,000 transfer, not $10,000. I'm not here to panic you. I'm here to help you protect yourself with concrete steps. Here are 5 actions anyone sending money abroad should consider right now. Step 1. Use electronic transfers from a U.S. bank account when possible. If you have access to a bank account, use it for transfers. That avoids the 1% cash-funded excise tax and creates clearer documentation of the funding source. Step 2. Never structure transactions. Do not split a $12,000 transfer into 3 $4,000 transfers. Do not bounce across multiple locations in a day. Do not ask others to send in a way intended to avoid reporting thresholds. Structuring exposure is serious under 31 U.S.C. 5324. Step 3. Keep documentation of where your money comes from. If anyone questions your transfer activity, records matter. Keep pay stubs, bank statements, tax returns, and W-2s or 1099s organized. If income is legitimate, documentation is your strongest protection. Step 4. File taxes correctly and on time. I understand the concern given the IRS-ICE pipeline, but not filing creates additional legal and immigration complications. penalties, interest, and problems proving continuity. The key is accurate filing and professional guidance. If possible, consult a tax preparer who understands immigration-related risks and documentation. Step 5. If you are eligible to open accounts, consider doing so in a way that keeps funding sources clear and lawful. Some families use joint accounts when permitted. The goal is to use documented, traceable funding methods rather than cash-based transfers whenever possible. Now, let's put numbers on what sending money home costs in 2026. Scenario 1. Undocumented worker without a bank account sends $2,000 per month in cash through Western Union to Mexico. Monthly cost, $20 in excise tax, plus a Western Union fee around $10 to $15, plus increased reporting risk because each transaction exceeds $2,000. Annual, $240 in tax alone, plus recurring reporting visibility. Scenario 2. Green card holder with a U.S. bank account sends $2,000 per month, electronically by wire or other bank-to-bank methods. Monthly, no remittance excise tax when funded from the account. Annual, possibly $50 to $100 in wire fees, but no excise tax and a clearer paper trail. The difference is not only money, it can be stability, safety, and fewer disruptions. I also need to address informal transfer systems people call by different names: Hawala, Hundi, FinCEN, and others. Here's the legal reality. Operating as an unlicensed money service business in the United States can be a federal crime under 18 U.S.C. 1960, with penalties up to 5 years in prison. If funds connect to other crimes, tax evasion, fraud, immigration-related offenses, the exposure can rise dramatically, including up to 20 years. Treasury risk assessments have identified Hawala networks as a high-risk typology for illicit cross-border transfers. That doesn't mean every informal transfer leads to prosecution. But if your name is already in reporting systems, combining that with informal channels increases legal risk. My advice? Stay inside the formal system whenever possible. It may feel expensive and it may feel monitored, but having verifiable records and lawful funding sources is far safer than having none. Let me summarize with complete clarity. The $10,000 rule isn't the only issue. And for many people, it's not the main one. The major pressure points in 2026 include the $2,000 SAR environment affecting immigrants, the IRS-ICE data pipeline that has already impacted tens of thousands, the 1% remittance excise tax that falls hardest on cash users, and geographic targeting orders that increase monitoring near border regions. Transfers can be tracked, taxed, and shared across agencies. This isn't a conspiracy. It's built into statutes, alerts, court rulings, and published thresholds. Protect yourself. Protect your family. Use the 5-step plan and share this video with anyone you know who sends money home, because most people have no idea this system exists until it hits them. Call to action and closing. If this video helped you learn something you didn't know, hit the like button. Subscribe to Senior USA Hub because I cover these issues weekly with original source detail. Leave a comment below. Are you sending money through Western Union? Are you using cash? Do you have a bank account? I read the comments and I'll respond where I can. Next week, I'm covering the 7 things you should remove from your phone before arriving at a U.S. airport. CBP's updated electronic device search directive went into effect April 28, 2026, and it affects every traveler. You don't want to miss it. Until then, stay informed, stay protected, and I'll see you in the next one.